What historically could have been a game-changing announcement ended up being a much less significant event for markets. Investments Chief Executive Charles Hepworth commented on the Bank of Japan's recent decision. Indeed, after Japan's regulator completed the policy of negative interest rates and yield curve control, the balance of trading forces changed a little on Forex. Moreover, a huge gap between interest rates in Japan and other leading economies still exists. The Fed's official funds rate now stands at 5.5%. Interest rates in other major central banks are above 4%. In Japan, the key interest rate is only a minor 0.1% above the zero level. Moreover, the Bank of Japan will hardly raise it to higher levels in the coming months. For example, former Bank of Japan official Nobuyasu Atago believes that it may even take several years before short-term rates in the country rise to even 1%. For this reason, the yen was again under pressure from rival currencies, and the carry traders breathed a sign of relief. In a carry trade, an investor borrows funds in a currency with low interest rates and invests their returns in a high-yielding currency. As a practice has shown, a 3-month carry trade of the dollar-yen pair can bring up to 5% annualized. Therefore, today the yen was brought like hotcakes. As a result, its price fell to its lowest level in 4 months against the US dollar, a 16-year low against the euro, and its lowest level against the pound sterling since 2015. This trend has gained momentum also because the ECB and the Federal Reserve will maintain the status quo on the interest rates in the near future and will not cause strong volatility in the market. However, given that annual inflation in the United States suddenly rose to 3.2% and core inflation fell less than expected, it's quite possible that the US regulator's plans for a rate cut in June have also changed. First, analysts are taking a more hawkish tone in their forecasts. Second, they admitted 2 rate cuts this year instead of 3 in the previous forecasts. The Federal Reserve gave up the idea to cut interest rates too much or too quickly this year. This encouraged impressive gains of the dollar. However, the stock market, which is riding the wave of interest in artificial intelligence, is also not lagging behind. Thus, the SP 500 again updated its record high, and this time it broke through the resistance of 5,180. Today, it's also trading higher in the intraday corridor between 5,174 and 5,183 points. The dollar bulls today also overcame serious technical resistance at 104 points. As a result, the US dollar index followed the uptrend on Wednesday in the intraday corridor between 103.80 and 104.20. Today, the Fed's dot plot, that's a forecast of future interest rates, as well as more aggressive comments from Jerome Powell, could push the US dollar to new highs. While markets froze in anticipation of a statement from the Federal Reserve, there are speculations in Europe about when the ECB will venture into rate cuts. ECB policymakers are divided into 2 camps: those who advocate for the first rate cut in June and those who admit this policy move in the early spring. Yesterday, ECB Vice President Luis de Guindos warned that this move will have to wait. Today, ECB President Christine Lagarde, Chief Economist Philip Lane, member of the ECB Executive Board Isabel Schnabel, and Bundesbank Governor Joachim Nagel make their remarks. Almost all of them, in their comments, underscored inflation deceleration in the European Union countries. Easing inflation is an important factor for the Eurozone regulator to cut interest rates. This scenario is bearish for the euro. Therefore, after the comments of several speakers, the single currency is moving lower today within an intraday corridor between 1.0840 and 1.0875. After some volatility, the euro-dollar pair worked out the reaction to statements by the ECB officials and went into consolidation. The euro is likely to remain in this narrow corridor until the Federal Reserve unveils its announcement on the funds rate. Popular media are full of reports that Jerome Powell today will not only specify the timing of rate cuts but will even indicate the scale and the pace of monetary easing. This is what caused yesterday's rebound in the US dollar. And today the greenback may increase pressure on the euro. Therefore, the euro-dollar pair risks falling to lower levels towards the technical support of 1.0800. Lower interest rates tend to weaken the currency, so the euro could come under pressure from the two central banks, the dovish ECB and the hawkish Fed Reserve. The firm US dollar is also putting pressure on oil prices as the crude becomes more expensive for buyers in other currencies. Demand is falling, and along with it, oil technical charts are going down. For example, the benchmark Brent slipped below the $87 today. The reason is not only the strong US dollar, while markets are cautious in anticipation of the Fed's policy statement. Investors decided to take part of the profits from a rally in oil prices. A week ago, the main driver of the oil rally was a decline in crude and fuel inventories. This weekly update is also published today. If US fuel inventories decrease again, then oil will receive a good catalyst for further growth. In the best case, its price can regain its footing around $87 per barrel. Brent futures have risen in value by almost 6% over the past 5 trading days. However, at the same time, the technical chart shows a high overbought level, and this indicator may signal a pullback. Perhaps now we are already watching a downward retracement, and oil prices may also resume growth, but only within the framework of the initial speculative phase that now looks very unstable. You have watched the market review by InstaForex analyst for Wednesday, March 20. Subscribe to InstaForex TV channel. And we keep you updated on all market developments. Feel free to ask any questions and leave comments. See you online tomorrow.